AI disruption fears triggering a major rotation on Wall Street. Investors moving out of vulnerable software names and into companies with hard assets that make real things. Wall Street has a name for these new market favorites, halo stocks. Andrew, there's always an acronym on Wall Street. It was FANG, it was Mag 7, not an acronym, but you get the idea. Tell us about halo.
Halo stands for heavy asset, low obsolescence, and it's basically a lot of industrial companies. You've got stock companies like Caterpillar, Deere, General Electric, which makes airplanes, Union Pacific, Honeywell. And investors have been rotating into those stocks because they feel that they will not be disrupted by AI, could be beneficiaries, and they have pretty big competitive advantages or moats.
Are those the biggest movers, the ones you just listed?
Well, you know, if you look inside the Dow, the biggest winner in the Dow has been Caterpillar. It's up about 25, 30%. Deere, up almost 40% this year. You've got some pretty high multiples on these stocks now. Some of these stocks are trading for 30 to 40 times earnings. They're actually richer than some of the Mag 7 stocks. So it's really been a pronounced move this year into these stocks.
You know, the first time I actually heard this term was with the Substack post that my wonderful colleague produced. And it was interesting because, you know, he really went into, you know, interesting detail. It's a must read. I'm telling everyone now, read it. It's very easy to understand.
Right?
That Josh guy.
Yeah,
that Josh guy.
Searching for signals with Barron's on Substack. There
right?
you go. Yes.
Subscribe now.
Subscribe.
But it was interesting because we actually had a reader kind of talk a bit about this. And he posed an interesting question, whether these halo trades are a permanent structural shift or if there's somewhere to maybe hide out while the AI's trade sort of sorts itself out. I'm curious, Josh, what was your kind of take on this?
Yeah, so I think when you think about how long this can last, right, and you go through history and you see these periods where the market gets defensive and you see multiples expand in some of these staples, it doesn't usually stick. Right? That is not something that stays for a long time. So Walmart right now, trading at almost 45 times next 12-month earnings. That's its highest valuation since 2000. But in 2000, it eventually unwound, right, that valuation. And so I think maybe you see something similar to that. I mean, Amazon, to Andrew's point, is trading at, I think, 26 times. And so that's at its lowest valuation since 2008. So really, I think you have a large imbalance right now, and it feels like maybe a tough thing to just dive in and chase.
Interesting that moment in Walmart's history was the exact same time that Amazon surpassed it in total sales. So what you just set up was an interesting dilemma for investors. You know, the market's hating these software stocks, but do you really want to buy Walmart at 45 times? What do you do?
I think maybe you just take it from an index perspective, right, Jack? I mean, if you look at the S&P 500, the top 10 companies are about 40% of the index. So that is why the index hasn't really moved that much this year, because tech hasn't worked. So instead of buying maybe SPY, maybe you buy RSP, the equal weighted S&P 500 index. That's been an outperformer this year. We brought up industrials earlier. That's been an outperformer. There are also earnings revisions moving higher for XLI, so that's been a winner. Maybe you just hide in some of those other areas, and basically diversification is what's winning here.
Andrew, where do you come down on this? So Lisa Shallett says that this is overblown, these fears about the AI disruption. Obviously, some investors disagree when they're showing that with their money. What do you think?
I think there could be some opportunities in some of the better companies that have been disrupted by this. Barron's has written favorably on S&P Global, which is the major credit rating agency, which is now trading low 20s multiple of earnings. Moody's, which is its competitor, came out this past week, and they were trying to downplay the AI concerns. And you've got MSCI, which is an index provider, and you've got Fair Isaac, which provides credit scores. So I think they're stocks that I think should do okay. I'm a little bit less enthused about the software stocks, which everybody seems to be screaming is a buy right now. One thing investors don't really focus on too much is that the earnings of these companies that they report are inflated by a lot of stock-based compensation. And if you strip that out, there really is not a lot of earnings at many of these companies.
Yeah, on the positive side, I feel as if the enterprises who are their big customers, it's going to take them a while before they trust sort of a homemade AI agent to do their payroll or something that requires great security.
Yeah, I mean, that's true. But I mean, the question is 5 or 10 years from now, what are things going to look like? And
to Josh's point, we're trying to price that.
That's the so-called terminal value problem you're seeing right now in the stock market affecting these stocks.
Let's talk about the Mag 7. You're kind of on the rocks right now. Anything you guys like in that space? What's your favorite Mag 7 stock?
Apple. That's really what we just talked about, right, is who is going to be around in 5-10 years doing the same exact thing. I think Apple's going to be selling us iPhones in 5 to 10 years, right? You're holding yours right now, Jack.
It's a real thing.
You're going to get a new one if it breaks. I like Apple.
Yeah. Megan, what about you?
I think Alphabet. I mean, Google's parent company is doing something interesting where it's actually getting returns for its investment on AI, particularly in its ad business. I think that that's a positive sign and one worth, kind of keeping an eye on. And it's good news for everyone.
And whoever wins in the AI race will probably be using them on our phone. Andrew, what about you?
I'd say Amazon, which is, as we point out, one of the lower valuations it's had in about a couple decades now. You're seeing some notable buying from some big investors disclosed recently, including Bill Ackman. So I point to that. I also point to Berkshire Hathaway, which is not a Mag 7. It's arguably a Mag 10. It's a lot of industrial businesses inside there. They own the biggest railroad in the country, Burlington Northern, a big utility. It's also, stock's basically down this year when many of its competitors are up.